be instantaneous, wouldn't you? But unfortunately, it still takes a few seconds. Okay. As our numbers are still coming in, I'm going to get going, if that's all right. I'm Sean Kidney. I'm the CEO of the Climate Bonds Initiative. We're a global NGO for green bonds and the like. And we're focused on working with investors and, of course, corporates and governments on mobilizing capital for climate change solutions. We are today doing this webinar in collaboration with our friends from MUFJ and from FICCI, the Federated Indian Chambers of Commerce Industry, as part of our work to let the world know about this revolution that's underway. There is a revolution underway in financial markets. We have seen an extraordinary growth in the last few years of what we call thematic bond issuance. When we started work at the Climate Bonds Initiative some 10 years ago, and when I first met Gaurav a few years later in Mumbai, when we started talking to issuers about this idea that investors were interested in the green and the social and sustainability activities of corporates, we had a market that was really only about 1.5 and then 10 billion and then 200 billion. It's now, at the end of last year, $1.7 trillion US, that is, not rupees, US, and it's growing at a rate of 80% this year. We expect to see a run rate by the end of this year of $1 trillion. But that's not the only thing, because the green market has given rise to various other thematic instruments, all with the same idea, that we can make capital work while capital is doing good. We now have a green, social and sustainable market of about $2.7 trillion US outstanding. Again, growing very fast. We've seen the growth of sustainability linked bonds, another instrument, which we'll hear a little bit more during the session, which is corporate announcing objectives and targets that it's going to achieve and providing investors a little bit of a trigger on the coupon if for some reason they don't achieve those targets. Very important in terms of assessing the targets. This market is going crazy. Of course, the people we have on the panel today are part of the participants in that particular market. We have a really fantastic panel to talk about what the opportunities are and what the issues are. We will, in a minute, move to a recorded interview with Nazmira Mullah, who's the Chief Sustainability Officer of 91, one of the largest emerging market investors, and with Emily Weng, who's a Vice President at BlackRock of ESG Fixed Income, talking about what's going on, why this interest on the part of investors. I mean, we know the background, we know the enormous challenges that we face as a planet in addressing our Paris Agreement targets. We've seen the Indian government's dramatic announcement around clear targets for 2070 net zero and intermediate targets. We've also seen the extraordinary growth of renewables in India in the last few years as part of the Indian government's commitment to making a change to its economy, its environment, its industry. But of course, a lot more needs to be done before we get there. The McKinsey's, the consultancy, put out a report a couple of weeks ago, which said that they see the global capital flows required to address their capital challenges are in the order of about $9.2 trillion US per annum. That is a very large slab of capital. The US economy, by example, is $17 trillion GDP in size. Of course, there is some good news. A lot of that is the refocusing of existing capital flows. Financing for energy switches from fossil fuel to clean if we do this right. There is a new CapEx penalty, about $1 trillion of fresh CapEx, because a lot of our investments, like renewables, like rail, are high CapEx, low OpEx. That is, they're front-loaded. So we will have a capital lump, but we're lucky. At the moment, we have enormous savings pools globally, managed by the likes of AllianceBernstein, BlackRock, and 91. We've seen a quadrupling of institutional investment savings pools during the time I've been working, and that continues to grow. We have the capital. It wants green. That's the evidence that the green bond market shows and the green and sustainable bond market shows. Well, that's my thought anyway. Today, we'll have some fantastic panelists who will talk a little bit about their experience Gaurav Bhagat from MUFJ will moderate the session. We'll have Kailash Vaswani, who's the President Corporate Finance from Renew, one of the big green bond issuers in the Indian market. Pavan Kumar Agarwal, CFO of Azure Power, another large-scale green bond issuer. Robbie Singh, Group CFO of Adani Group, that again has also been issuing a lot of green bonds at scale. And Sashagiri Rao, who's the Group CFO of JSW, will talk a little bit about their very interesting bond experience. And then finally, from HDFC, the elephant of the room, the most successful bank in Indian history, as far as I can see, V.S. Rangan, who's the Executive Director and CFO. And then we'll have Salima Lamdua, who's the Portfolio Manager at Allianz Bernstein. We'll wrap it up, and then we'll hear from Rita Raj-Joy from FICCI, and then Shashank Joshi from MUFJ. But first, a quick video with my friends Nazmira and Emily from 91 and BlackRock. Cue to you, producer, please. Nazmira, Chief Sustainability Officer at 91. I love that title. And Emily Weng, who's the Vice President of Fixed Income ESG at BlackRock. Thanks for joining me. Emily, I'm going to start with you. What's happening here? Why is this extraordinary investor demand in green and sustainable investments? Tell us the picture from BlackRock's perspective.
Yeah, thank you, Sean. I think this is really driven by our investor community. I think there's been a big change in demand for green because everyone's decarbonizing. The pressure is coming from top down. It's regulatory. It's from investors' boards. It's from their clients' as well. So this is, I feel like, an inevitable movement in all senses of the word. And we really see that matching when it comes to issuers as well, issuing green bonds to meet this demand. And in fact, there's more demand than there is supply in this space, which is a good thing for issuers. But what that means also is investors at times are willing to pay up for a lot of these issuances. And I think the story of pricing benefits and supporting the green movement really is there. But I think from our perspective, we're very supportive at BlackRock of the green, social, and sustainability bond market. We think that the use of proceeds structure is super defensible. It's the ring fencing in structure really helps us sort of to have clarity and the transparency that we want. And it helps us to fund, the actual investments to our own end clients as well, to say, hey, I know exactly what these projects are funding. I know what the issuer is using the proceeds for. You don't have to worry that it's getting commingled with general corporate purposes or other types of working capital. So, we find that a very easy narrative to defend. It's something that definitely helps, a lot of our issuer community transition. And from the investor perspective, I mean, it's really a win-win in all senses of the word.
And are you finding that this is across your investor base? I mean, you have the largest investor base in the world in terms of clients. In terms of this appetite, I mean, I hear a lot about BlackRock appetite, but just how broad is this?
Yeah, I think, if we were talking a couple of years ago, this really started in Europe, by no surprise probably, but I think more and more this is migrating to Asia, all over APAC, India included, China, with a lot of the signaling of taxonomies being established, green bond frameworks being established by a lot of sovereigns, and now even the US and America. So I think with Paris, with a lot of the targets, the NDCs that the various countries are setting, and really the top-down pressure on a lot of these issuers, we see that the movement has transcended Europe, where I think a lot of the origins are, and it really is a global type of movement. And our client base, it's across pension funds, it's across companies, management, and lots of sovereign wealth funds as well. So it is really across the board.
Nazmira, are you seeing this as well? You're an emerging market specialist, so you're very different. BlackRock has got a heavy emphasis on rich countries as well as emerging markets, but you're a specialist. Is it the same for people who are particularly interested in emerging markets?
Largely so. I mean, I think there's a bit more nuance in that, but it's very much the same trend. I think what we're seeing from our investors, which are often in developed markets, investors in developed markets, investing in emerging markets, is you're seeing the same view coming through. So starting in Europe, you're seeing a massive push towards trying to support transition in emerging markets, to actually decrease the carbon footprint of their portfolios in some cases. And, that's a conversation we're having with our investors around needing to support the transition process across EMs. But as Emily alluded to, this is spreading. It's no longer just a European-wide phenomenon. We're seeing this coming from other parts of the globe as well.
We've got a particular interest in India at the moment. We're talking about ESG investments today's forum. Appetite for India, is it differential? Is it less, more, the same? Nazmira?
I think there's plenty of appetite for India. I think a lot of the green bond issuance you're seeing tends to be in funding renewable projects, either directly for the corporate benefit or for projects that are going to be selling into grids. And India is one of the largest issuers in the space. So there's quite a bit of green bond issuance coming from India. I think we're starting to see sustainability-linked issuance also coming out of India, where the step-ups are marginal. So, from a 91 perspective, we tend to prefer green bonds to sustainability bonds, as long as there is that clarity. There is that issue around clear use of proceeds, which is consistent with the World Bank methodology, regular reporting. That is something that we are very happy to support. Our clients are interested in as well. And as Emily pointed out earlier, it's a narrative that we can easily explain.
What about currency appetite in this area? Is it a hard currency appetite, or is there Indian rupee appetite?
It's principally hard currency appetite at this point in time. I think there's some initial steps to try and transition into local currency, but the bulk of the international investor appetite is for hard currency.
Is that the same for you, Emily?
Yeah, I would say so. And I think this mirrors some of the issuance that you see in this space too, predominantly hard currency, a lot of USD issuance, to be honest, in this space. Some local issuance as well. But I think, from an Indian issuer perspective, they're coming to us and, they're looking for an international investor base. It is predominantly in hard currencies. And yeah, I definitely second, everything that Ms. Mira said earlier, in terms of where we're seeing issuance, a lot of cleaning up the grid, a lot of renewable issuance, a lot of funding solar and wind from what I see from a lot of these issuers. So that definitely mirrors the story. I think we're seeing issuers also across the rating spectrum. We see high yield issuers, we see IG issuers as well. So, we definitely have homes for green bonds, and a lot of our products, a lot of our funds, clients are asking for it. We have structural allocations to a lot of them in a lot of our funds. So, it becomes really, really easy to defend when, you have an issuer, you do a good green bond, it's funding these projects that, we already like and are aligned to the 2 degree scenario. It just makes it easy for everybody.
Fantastic. And scale on this, what do we tell Indian issuers in terms of the kinds of scale? Is it the same as in the West? You need to be $100 million US plus, preferably $500 million. Or is there something different about the Indian market for people to be aware of? Maybe Nazmira.
I think for our funds, the scale you're talking about makes sense, because what you want some sort of liquidity. You want to be able to enter issues and actually be able to trade out of them in future. So our funds across the dedicated EM credit part is $12 billion at this point in time. So we need some reasonable scale to take a position in issuances.
You're nodding, Emily. Guess that sounds like a yes. Similar?
Yeah, I think benchmark size issuances are definitely in line with what we're looking for. Not just the liquidity, but from a pricing perspective, in terms of just building the portfolio, getting the investor diversification from the issuer perspective. That's probably going to be easier when you have somewhat of a larger issuance, especially when you get the oversubscription. But I think a lot of times we also reverse in on deals. So if they can't build the pipeline for such large issuances, we can defend smaller ones as well, as long as the projects are defensible. So, we definitely partner with issuers on that too.
We've obviously got reallocations to some emerging markets underway now, and the search for yield by European investors and so on. Do you see this continuing in India with a green flavour going forward, or I mean, what's the appetite looking like in the future for you, from your perspective? Maybe Nazmira first, then Emily.
We expect the focus from investors around emerging markets in general, but specifically around supporting the transition in emerging markets to continue. So we would expect India to be a core part of that, given that it is such a big part of that story. And I think what you've seen across several emerging markets, notably India, is often the corporates are ahead of the governments. So they actually are being more innovative with what they're doing. They are well ahead of where government policy is in many spaces. And I think that you are seeing quite a large portion of the global investor base wanting to support that. Not everywhere, but quite a large portion. So we expect that to continue going forward.
For you too, Emily, that appetite in India growing?
Absolutely. And I think, you know, as Nazmira said, it's such a key part of the emerging market transition story. Just thinking about the number of people that live in that country and, you know, the need to clean up that grid. I mean, that alone is, you know, I don't even know how many billions dollars worth of, you know, financing opportunities. You know, I think we want to see as much green bond issuance out of that market as possible. We have homes for them here. So, you know, for us, it's really defining that transition, having those projects. You know, we definitely have, you know, the ability to fund a lot of them. So, you know, that's important to us, that just the underlying projects are defensible, especially with, you know, a lot of these energy sources becoming more and more economical and financially feasible. There's no reason to fund something that might be more expensive and, you know, extend sort of the useful life of fossil down the line. So, you know, it's definitely on both sides of that.
So this is an exciting market. We're about to cut to our panel of issuers now. Any last thoughts or messages for them and for other people considering issuing to leave them? I mean, apart from they'll be chasing your email address at some point, but what would you say to an issuer now considering it in terms of looking forward? Any last thoughts? Maybe Emily first.
Yeah, issue a green bond, issue a good green bond.
That's it.
That's it. We'll take them. We'll look at them.
Fantastic. Nazmira.
I'll be a little bit more long-winded. So I think firstly, we are very keen to support the transition in India as a concept. But first point. Second point in that is we want to work with companies in the country. We're already working with a number of them. We want to continue to do so, and we want to help you find solutions. And lastly, let me repeat what Emily said. Issue a good green bond, a good green bond. We're not interested in bonds that you know, are greenwashing. We're interested in good green bonds, and we will be very supportive of them.
Fantastic. But I just got to ask you about transition. When you say transition, you mean clearly more than energy. Do you just mean property and water, or do you mean industrials and maybe in agriculture as well? How far does the transition frame go for you?
It goes pretty far. It goes pretty far. As you know, Sean, we've been talking to you a lot about this, it goes pretty far. So we're looking at transition across all the relevant sectors of the economy, working with companies as far as possible to achieve 1.5 degree aligned pathways, but where that's not yet possible, where the technology doesn't yet allow for that, just working with companies who are showing a serious commitment to reducing their emissions. So we have a pretty broad definition of transition.
Fantastic. And I imagine, Emily, similar. Are we on the right track here?
Oh, absolutely. You're hitting all the points on the dashboard. You know, I think transition is ultimately the goal, right? We always say, well, if you're transitioning, what are you transitioning to, right? If it's not a 2-degree world or well below, like, what is it really, right? So, you know, we think about ways to finance that and put that going forward. So, you know, to the extent that you have projects that fit in a green bond, to the extent even that you have, you know, other projects that would fit in that narrative, we're definitely supportive of. But, you know, I think the key is that we're transitioning to a well below 2-degree world. So, if you're an issuer and you're thinking about the projects that you're financing, think about what's aligned to that. And so, that definitely, I think, clarifies a lot of the pipelines and what investors like us are looking for in that space.
Fantastic. Nazmira Bola from 91 and Emily Wang from BlackRock, thank you so much for having joined us today, and look forward to working to you, especially on transitions going forward. Okay. Thank you. Gaurav Bhagat, Managing Director at MUFJ South Asia. It's a cue to you. I just want to say one thing. If anyone wants to ask a question, there's a Q&A button at the bottom of your screen. Use that. Audience can ask question by text. We'll respond to some online and some in the Q&A session at the end. Over to you, Gaurav.
Thanks, Sean. We'll get straight into it, but just some headline numbers to share. We have over 253 participants and over 45 investor organizations, multilads, fund managers, and banks who've joined this webinar. So I'll address the first question to Kailash. Kailash, Renew has been, and you're on mute. You have been one of the most prolific issuers of green bond, and you've also tested other formats like issuing onshore and loans. In terms of the overall scheme of things, your company has also been expanding into new businesses. Most recently, plans to set up a solar manufacturing plant, and it seems to be like you're integrating both forwards and backwards. So can you tell me something about what are your plans and how are you? What's the strategy here?
Sure. Thanks, Gaurav. So hi, good afternoon, everybody. So Renew Power is one of the largest renewable energy companies in the country in terms of commission capacity. And, we are also a preferred choice in terms of partnerships when it comes to, getting investor interest into us at the asset level or, from the corporates as far as, the power purchase agreements are concerned. Now, where we find ourselves is, in a fairly unique position that, renewable energy costs have been coming down. There's a huge demand for renewable energy, and, we would like to be present across the entire value chain. So, while earlier we were doing EPC and O&M for our projects in-house, and PPAs were done mostly with the government counterparties such as state governments or SECI, I think we have changed that and transitioned more backward into manufacturing. So we've announced cell and module manufacturing units. And if you get the benefit of PLI, maybe we'll go further deeper into the value chain. At the same time, we're also seeing a lot of traction in terms of demand from the corporate customers who are directly looking to buy renewable energy. And all of these customers mostly have their own net zero commitments, because of which they are keen to acquire or to replace their own energy requirements through renewable energy and clean energy sources. And we've demonstrated that, our understanding of the business by actually winning complex projects. We won the peak power project in 2020 and the RTC project, both of which entailed, some amount of balancing of wind and solar with storage and oversizing. And that has resulted in, a lot of customers actually realizing that the energy that they can source from renewable energy can be got at highly competitive rates. And on the financing side, again, we have been able to raise a lot of green bonds. We've also diversified financing from multiple other sources, such as multilaterals, Indian banks, foreign banks, etc. And so our objective is to get financing at the lowest cost possible, keep reducing the risk in the capital structure so that the cost of equity also comes down, and we are able to provide clean energy solutions at very competitive rates.
Thanks for that. I'll come back to you in a moment. Pawan, given that you've been one of the pioneers in the green bond market all the way back in 2017, how do you see this entire journey so far, and where is Azure placed? You had a very successful issuance last year, the lowest coupon achieved by a renewable energy company. So would you like to tell us something about that?
Sure, Gaurav. I think thanks to the government policies and thanks to the country very, very determined to increase and embrace the renewable energy. The way as a country we decided to scale up our renewable energy mission. So all the players, and then we have been among the first player who started the solar projects in the country at a megawatt scale. The journey has been fantastic, Gaurav. We have raised funds from multiple sources, and when it comes to green bond, we actually got our equity listed in NYSE in 2016. So we took India's renewable energy story closer to the global investor as early as 2016, and then from there, the journey started when it comes to tapping the market, the public market, and then in 2017 we did India's first solar green bond, and that bond was again a huge success, and that was followed by 2 more issuance, and the most recent issuance that you talked about, where we refinanced actually the first green bond that we did. We refinanced at a coupon which was lowest ever coupon issued by any of the Indian renewable energy player in the high yield segment. So the very honestly, the credit goes to everyone. Credit goes to the sector. Credit goes to the portfolio. We have all the assets that have been won on a competitive bid basis. The quality of portfolio, the quality of asset. Also, a very strong point is the quality of our sponsor. We are owned more than 70% by CDPQ and OMERS, who are the Canadian largest pension funds. So a combination of all of these has led to we getting very attractive rates, both domestically as well as in the green bond market. So I'll just take a pause on this and happy to take it forward.
Sure. Robbie, in terms of Adani, I think the group is in a unique position of being IG rated entity across most group companies with 4 IG rated businesses. And we also see that you're coming across a dominant issuer in Asia. As a member of the GRI South Asia Charter, what's the strategy of the group in terms of what components of the investments will be, green denominated, and what's the vision going forward? Robbie, you're on mute. I hope you can hear me.
Yeah. Thank you. I think for us, across the entire utility space, we started in the renewable sort of solar generation post majority of the pioneers like Azure and Renew who are here. But having said that, we do come with a very deep investment and very large investment within the utility space across utilities. So from transmission, distribution, conventional power, and now green energy. So our becoming the GRI charter member, that's largely because sort of the sustainability element of the ESG. We are ourselves large investors within our company. So from we ourselves own between 65 to 70% of equity in our companies, which means that we are intergenerational investors. So we have to look at it from the point of view of the sustainability element comes naturally to investment. So as the sustainability moves, our investment moves. So today we are investing close to 70% in or around the renewable space. And the volume of it is over the next 9 years, we expect to invest close to in the decarbonization of power generation. We expect to invest close to 20 billion in direct generation and about $5 to $10 billion in the transmission and distribution space to allow the distribution companies to be able to have grid capability to accept renewable power. Then on the decarbonization of industry, where we recently announced that we will set up a new vertical in green, which is called Adani New Industries. There, over the next 9 years, we'll invest close to 50 billion. And Chairman said around 50, we will be slightly, higher than that number. But that's our first, this next 9-year investment just in the renewable generation for power generation and for industrial decarbonization. which is green hydrogen and entire ecosystem related to green hydrogen. In terms of the utility landscape, we ourselves being part of a large portfolio, as one of the speakers said, our corporate PPAs, which are primarily within our own portfolio at the moment, are also quite significant in scale. So it's about 5.5 gigawatt is our corporate PPA size, which will be deployed over the next 3 to 5 years. So our and that's not the government linked or SECI or state government linked PPA. So as our overall investment increase at the portfolio level, our own corporate PPAs will also be very large in terms of the gigawatt. I'm talking of gigawatt scale, 5 and above. So this investment, the renewable investments, is about 70 to 80% of our total investments, and the logistics related decarbonization will be about another 15 to 16%. So about 90, 95, 96% of our capex is going to be in or around the renewable and sustainability space. Thank you.
It's a very compelling story, and I mean the numbers are just staggering. Mr. Rao, I'll come to you now.
Yeah.
So, Mr. Rao, you straddle several hats, and JSW Group is involved in steel, power, cement, infrastructure. In terms of, and you're also a member of the World Business Council for Sustainable Development. So, how does this fit into your overall group strategy, and how do you see this going forward in terms of various initiatives you undertake?
JSW Group, in fact, right from beginning, before the ESG awareness has come in the society and the investors, we adopted ESG long back. If I look at JSW Steel, which is our primary business, we brought in a technology called Corex technology in the year 2000, which was most environmental friendly, less energy intensive. So right from beginning, the group recognized the need to have ESG as a business imperative. So that is the main thrust of the group right from beginning in all the businesses. So today, the businesses where we are present, at least some of them, are perceived by the investors as hard to abate sectors. For instance, steel. But steel, as you know, is fundamental today, which contributes for the decarbonization and the energy transition story. Metals, if I look at it, steel is required, particularly in the renewable side, if you want to set up or creating infrastructure. So therefore, this industry is very, very important industry, where we are focusing right from beginning to reduce energy intensity and to do carbon emissions. So I think JSW Steel went ahead and then declared that we will reduce our carbon emissions by 42% by 2030 relative to 2005, when India has committed in the nationally determined contributions that they will reduce by 33%. So we are far ahead compared to the nationally determined contributions of India. So this story is repeated in each of the sectors where we are present. If I look at JSW Cement, which is also perceived hard to abate sector, our carbon emissions in the JSW Cement is 1/3 of the global average. If I look at JSW Power, JSW Energy, so that is the sector where we are completely transitioning to renewables from the thermal. So we will be setting up 10,000 megawatts of renewable power by 2025, and this will go to 20,000 megawatts by 2030. So that is the kind of plans which we have. So if this is the growth plan for decarbonizing our sectors where we are present, in line with the India's commitments, then we wanted to demonstrate and explain to the investors where we have done sustainability linked bonds and green bonds in some of the verticals where we are present. I think the kind of response we have received is overwhelming in each of these issuances. That also enabled us to access the funds of long tenor, very high quality investors and very competitive cost. Therefore, I think what investors' interest, particularly in contributing to energy transition and decarbonization, I think will immensely help for expediting this journey. Thank you.
No, thank you, sir. Mr. Rangan, HDFC Limited is the platinum standard when it comes to governance. I think it's widely acknowledged that the group has done stellar work in terms of various reporting standards. And you're also a very dominant issuer of bonds onshore. You are the largest issuer till date of masala bonds. And you also have, launched green deposits and taken, a facility from IFC for sustainable and green buildings. So in terms of your overall group strategy, and especially in light of what's been announced in the budget in terms of, the thrust for affordable housing, what do you think is the overlay in terms of the landscape currently, and what needs to be done to encourage access to financing to this sector? It's a very key sector for most Indians and very close to the heart of everybody who wants to own a house. So over to you, sir.
Thank you, Gaurav. I mean, you are very right that this sector, the housing sector in India, has been growing very fast. And if you really go by, the growths which we have been seeing in the retail loan segment, we have been growing at a rate of 16% on a AUM basis year on year. And this growth is continuing. And on the back of a lot of, I would say, developments happening from the policy side, from the taxation side, from the state government side and all that. And particularly in the affordable housing space, where we have seen right from the time the PM Awas Yojana has been starting with the CLSS subsidy program and others, with the whole, the pace in terms of continuing this growth in this sector has been very, very exciting. Having said that, we are one of the largest mortgage finance companies in India. And as you said, we are one of the largest issuers of bonds in the domestic market. Unfortunately, our issuance of bonds in the overseas markets has not been there so far. And I mean, as most of us are aware, actually, that under the Reserve Bank guidelines today, the any access to external funding by entities, particularly in the financial sector, other than those who are in the real sector, particularly in the financial sector, there are induced restrictions are there on the money which is raised. So whether it is raised by way of green or whether it is raised by way of normal bonds, the induced conditions continue to be there. So what really happens is that those induced are little restrictive. And one of the things which we have been sort of presenting to the government and the regulators is that the green part of the activity, whether it is green buildings or whether it is financing to even an individual who is actually initiating certain ESG related activities. So whether it is relating to water conservation or whether it is relating to energy saving within the building, all those things should sort of fall within the sort of induce permitted under these regulations. Similarly, for example, there are a lot of these commercial buildings which are constructed on extremely very, very good green certifications. And particularly because all these commercial buildings are used by very highly rated international and domestic corporates and banks and others, which themselves have got a huge commitment to this whole ESG framework. So that is something which currently is not there. So it needs to be sort of looked at. And if you look at the overall thrust given outside the this thing, I mean, on the housing side, you have tax concessions, you have projects which are actually affordable housing, they enjoy a tax benefit as far as the developer is concerned. There are also deductions available to the individual borrowers, both in respect of interest and principal. And last year we saw the state government actually relax the stamp duty on the properties, and one or two other states also tried to follow that. So all these are happening on the sidelines actually. On the green side, particularly on the, since the topic is more on the green and ESG related bond issuances, I would say that a framework where the policies and these things get more adapted to that, would make it far more easier for financial institutions to issue more of green bonds relative to what the real sector has been issuing so far. Coming on to our little initiative around the domestic market. So we are committed to the ESG framework, and we have launched a green deposit voluntarily on our own. We have a public deposit program where we have launched this. And the idea is that we try to get the Indian investors also to accept this and start pulling resources and savings towards this green initiative. And the commitment which we have given is that these monies will be used in green and sustainable projects and for loans which qualify there. And we will have a sort of we'll get a certification around the end use and all that, so that the investors are also fully informed about the end use of this money. So this has been started recently. It's not a very large pool which we have collected, but I think the start is quite good. We have collected about 60-70 crores of money under the program, which I think is good. On the other side, some of the, as you rightly mentioned, the IFC and the other borrowing which we have raised as a external commercial borrowing program, not under a bond route. So there what is happening is that besides the end-use restrictions for the RBI, so we have to actually meet with sort of two end users there. One is, of course, the regulatory end use which we have to meet, and on the other hand, the ESG frame, the end use which we have agreed to with as a contractually with the lenders, that also need to be sort of adhered to. So we are actually on a sort of a dual road there where we have to meet both the ends, and that's a little challenging, but nevertheless, I mean, it is a way to start. And then given the discussions with the regulators and others, it seems that the policy regime, we will see a much better policy regime towards this ESG and other related matters going forward.
Thank you so much. I think that's something which is very key and will probably encourage a lot of issuances going forward. I'll come back to you on a couple of other questions, sir. Coming back to Mr. Rao. So in terms of, sir, the entire emphasis on, and a lot of discussions around green steel, what do you think needs to be done to actually incentivize producers like yourselves so that, it forms a component to so many different things and will form a big part of the infrastructure play also. So what do you think needs to be done what are the enablers do you think which will be required to encourage producers like you to focus and invest more in the production of green steel?
As I mentioned to you, the steel industry particularly is very hard to abate sector. It is very, very difficult in the near future to replace the coke in the blast furnace with any of the alternate fuel. So the immediate steps which steel industry is taking is how to become very efficient in terms of operations, and also to completely transition from the fossil fuel based power that is being used in the steel industry to renewable power. That is the second step which we are doing. The third one is increasing the use of scrap. There are a lot of measures which are taken to reduce the carbon emissions from the current levels. At the same time, the alternatives to become carbon neutral as far as steel sector is concerned, the new technologies which are there is, one is CCUS, that is carbon capture and usage and storage. The second is hydrogen-based DRI steel making. There is a huge amount of R&D which is going on across the world. But as far as India is concerned, what we are really looking forward is that the entire hydrogen ecosystem in India, how to develop. Hydrogen policy is being announced today by the government. So we are very anxiously awaiting for that. Number one is how do we produce hydrogen? How do we enable to produce hydrogen by creating a manufacturing facility of electrolyzers and components in India. Thereby, that will create a manufacturing ecosystem as far as India is concerned. So the PLI scheme, which is announced for various sectors, we are also waiting for electrolyzer and component manufacturing. PLI scheme will be announced by Government of India. The second is with regard to the usage of hydrogen and the infrastructure system that requires to be created. So we are really looking forward to the government to give some fiscal incentives and also access to carbon finance. These are some of the areas where we are looking at to set up this ecosystem for transportation and making available to the user. The last point, which we are also looking forward in this hydrogen policy, is how do we ensure that the additional costs which are being incurred by the producers like steel sector, if I have to replace coke with hydrogen at a current cost of around $4 to $5 per ton, it is very expensive. For instance, every ton of steel requires 72 kg of hydrogen. So if hydrogen is available at $4 to $5, then it costs so much, $400 plus, relative to coke, which is around $150, $200 per ton. So that is the kind of extra cost which is to be incurred if it is completely a green steel replacing coke with hydrogen. Unless hydrogen becomes really available at a very competitive cost, it becomes very expensive. So first, creating an ecosystem starting from manufacture of hydrogen to the user, and also to ensure that the green production services, the demand is available in the market. Even assuming some of the steel companies like us take initiative of producing completely green steel, we have to get premium. The consumer should be willing to pay the premium. Our government has to subsidize the cost until really hydrogen becomes competitive. One of these two things are to be done really to transition. Until that time, there are a lot of efforts to reduce the intensity of carbon emissions in the steel sector, and at the same time working towards carbon neutrality through these technologies.
That's a very well thought out answer. Thank you for that, Robbie. I wanted to ask you on. Okay, Sean's put up his hand. Sean, you want to go?
Well, it's a cue for Robbie in a way. I want to say to Mr. Rao, if one of the other parties around this table were able to produce green hydrogen at a much lower price than what you're thinking is going to be done now, if we could get the price down to a third of what you're doing, would that change the economics of your forward CapEx plan? Would that rethink it?
We are really looking forward. If hydrogen is available, I think we are the first steel company immediately to do that. So the effort, today economics is what drives the transition. So if it becomes affordable, then it will be. Until that time, a lot of efforts are being done to reduce the intensity, and at the same time, looking forward in the next few years' time to transition to green hydrogen. Yeah, we are all expecting green hydrogen becomes affordable at $1.5 per ton in the years to come.
Let's see what the others say about that. But that's exciting. There's potential there.
Yes. Robbie, your views, you've been in discussions with various global majors in this context. So how do you see this panning out? What's the interest there? And, again, what should be the enablers to get this going? You're on mute, sir.
The good thing is that, we have forward-thinking companies, which Mr. Rao represents it. And India has a tremendous market sitting behind it. So our largest single investment of our group is going to be in the space of Adani New Industries, which is primarily a euphemism for green hydrogen. So the Adani New Industries is a two-part process. The first process is that we'll invest close to $3.5 billion, of which 2.35, I think to be exact, have been committed now into the manufacturing ecosystem, which goes from foundries in case of coming up to modules, foundry, wafer, ingot, module lines, glass, back sheets, aluminum frames, etc. on the solar module side, wind turbines, and electrolyzer plants, manufacturing electrolyzer within India as an ecosystem to create a supply chain integrity and ecosystem. Our aim is that we want to land green hydrogen costs at approximately 0.97 cents per kg. And we want to, and that's our objective. And what we are going to do is to commit to this Our chairman, Mr. Adani, has committed 50 billion into this area, and we will be investing in this space. And that for us as a group of past 1 year, this is the largest single investment we committed to a sector, which is the decarbonization of industry. And we will bring it at a scale. Initially, we will come in at about $1 about 50, and over a 3 to 5 year period, we will land at about 0.97 as we scale up the hydrogen. And this entire ecosystem that Mr. Rao referred to is an ecosystem that would be in relation to the physical infrastructure that's required to support the industry that will use the hydrogen products like methane, and all the way to agriculture. We have a touch point with agriculture through Adani Wilmar. So we understand the requirements of agriculture. We certainly have touch points in industry. So in short, we believe strongly that in hydrogen, India will play a leading part in this fuel going forward. It will not be others, it will be India. And we are committed to this, and we are very confident that we'll deliver green hydrogen at a price point which will be a third or even 25% of this it is today. Thank you.
Thank you. That will indeed be game changing. I'll come to Pawan now. Pawan, in terms of what do you think? The renewable energy sector needs to do to, keep pace with all these changes, and how do you think there's is there obviously there's space for both, given that we need $160 billion of investment to get to our net zero targets as a country, but clearly there's a lot of innovation going on in the non-renewable energy in terms of other fuels. So how do you see the renewable energy sector reacting to that? And I'll ask Kailash the same question.
See, I think this sector itself has huge amount of growth and opportunities to offer. And as you rightly said, there are a lot of related technological advancements and developments that are happening, wherein renewable energy can act as a very, very strong partner. And all the players, including players like us, can hugely benefit from all these developments that's happening, right? So when you talk about green hydrogen, the supply of green power to make that hydrogen become green is something which itself is a huge opportunities. Then there's a lot of there's a huge amount of interlinkage, right? There's a huge amount of common connect, whether it is the funding, whether it is the sponsor, whether it is the market. All of these can make the entire process very, very efficient. And that's the reason, Gaurav, you see a lot of players. And then you briefly touched upon Renew getting into different technologies, including green hydrogen. I'll also share that as a company, Azure also, we have been known to be only a solar company. Now, recently we have got into wind, we have got into hybrid, we are getting into green hydrogen, we are getting into energy transition, we are getting into storage. So all these interlinkages are something that for the player like us, it is going to be available, and all of us will benefit from that. The core theme, which is sustainability or ESG, is something which has been core to Azure. We are proud to be one of the highest ranked sustainability company in India. We have been rated AA by MSCI. Our risk category by Sustainalytics has been reduced from moderate risk to low risk. And as we move along in our path, we expect our rating category to further improve. We have done several steps with regards to water neutrality, because as a solar company, there's a lot of cleaning is required and there's a lot of water consumption that happens. What we did, we have reduced our water consumption from 122 liters per ton. Now it is coming to close to 48 liters. We are also doing a lot of robotic cleaning. We are doing a lot of water recharge. So very honestly, this sector is so much interlinked. And as long as you keep working on the path of sustainability. And as long as you have right sponsor, right investors in place, you're likely to benefit from all these advancements and all these diversifications.
Kailash, what's your take on the same question, given the fact that you've been very innovative in terms of raising funding across various formats? So how do you see this panning out? You're okay.
Yeah, hi. So, see, capital is definitely required to, have these very large mega plans in the country for transitioning, to net zero and reducing the carbon footprint of the country as a whole, and also in addition to that, increasing the adoption of renewable energy. Now, renewable energy, is infirm energy. It's not firm. It's not schedulable. So obviously, you need to sort of balance it out with storage systems, and that will ensure that renewable energy can become firm power. Now, currently, cost of storage is very high, but again, lithium-ion battery prices are coming down rapidly. The expectation is that it will come down to 58 kilowatt hours in the next few years' time, and that will obviously increase the adoption of storage as we go forward. We are one of the only companies in India right now who's actually doing a large 150 to 200 megawatt hour type of battery storage project, which is for the peak power capacity that we are setting up. And for that, we partnered with a company called Fluence, which is a very large company out of the US. And they have installed capacity and contracted capacity of almost 3.6 gigawatt in 30 markets globally. So again, the idea is to partner with the best players, get the expertise into the country, and work on policy level to ensure that the adoption of storage becomes more endemic across all the various subsectors in the country. We're expecting basic custom duty to come down because currently it's at 20%. So if that is brought down, then the cost of storage will become more attractive. There is GST, which is applicable. Again, that needs to be brought down. So like, a lot of policy support was given to solar, wind in the early stages of the infancy of the sector. We are expecting we would like similar support to be given to storage solutions so that, there can be a larger adoption of that. Then there's also things like ancillary services market for primary reserve, where again, storage will provide the highest value and can be used to subsidize the current high cost of storage and increase the adoption so that, as you keep improving and increasing the adoption of technology, the prices will come down eventually.
Thank you for that. Mr. Rangan, I'll come to you before we ask Salima to comment on the panel so far, and we have some questions for her also. HDFC Capital, you recently announced closure of a $1.88 billion fund on affordable housing. Can you tell us something about it? And right now, the case for equity funding seems to be more compelling for the likes of you. So what's the strategy here?
So basically, this HDFC Capital Advisors, this is a management company which basically runs property funds. So they already have done 2 funds, and this is the 3rd fund they are doing. And broadly, I think most of the funds they have raised, they are very long duration. They are about 10-year duration type of funds. And they have been investing in the equity and other debt requirement of the various affordable housing projects. On an overall basis, if you look at in respect to the amounts deployed in the last 2 funds, the average, the unit costs have been in the range of most of the units are in the range of less than $100,000 US. So it is completely focused on affordable housing space. And over and above, the fund which deploys in the various projects, they've also tried to look at the other ecosystems within the housing space, which is, for example, water metering systems, or it could be the technologies relating to the analytics in the in the housing market. And it also looks at technology of using the workers and others within the site and all that. So there are various companies which are actually specializing into some of these solutions, and some of them are into the space of ESG in terms of conservation, or whether it is in terms of saving the the power bills and things like that. So they are basically collaborating with all these. They are also looking at putting equities in some of these smaller companies which will actually sort of serve this whole ecosystem of housing, not only giving money to developers to construct housing, but also enabling them to sort of use other technologies and this thing in an efficient manner, which would lead to in sorts of managing the cost of the project. And also there is a ESG component in their fund, where some of the investors who have come in there specifically, we have sort of taken a covenant to cover affordable housing projects which are in the form of either green or socially sustainable and things like that. So that's what the theme of the whole fund is all about. So it addresses both the needs of the developers in terms of meeting the project cost and project development. It's also trying to bring in the other ecosystem providers who can actually help these projects to use it very optimally in terms of execution of some of their project related programs.
In fact, I think with your excellent reporting standards and the overall credit, etc., I think as and when you decide to embark on the path of issuing ESG bonds, I think it'll be a blowout success. There's no doubt about that. Salima, we would like to get your observations so far in terms of the panel, and I have some certain questions for you, hopefully, which we will be able to take up.
Sure. So I'll just take a step back and just try to frame why, as investor, we are so interested in this Indian market. Climate risks, we have increasingly come to the realization that they are systemic risks for our societies, for our economies, etc. India is home to 17% of the world's population, and it is urbanizing at a rate of a city the size of Los Angeles, basically every year from now to 2040. They're currently responsible for only 7% of emissions versus 17% of the world population. And we need to ensure that, levels of development and urbanization can happen in a way that is different to how the Western economies have done it historically, because otherwise we are going to get into a climate disaster. Hearing what I'm hearing now, and we've been looking at this market for a very long time at AllianceBernstein, we are very heartened to see that there is this sense of agility and innovation within the Indian market. Some of the stakeholders that I'm seeing here are very familiar faces, and the fact that we are addressing, we need to build more houses, but we need to make sure these houses are sustainable from a climate perspective. We need to create the ecosystem for hydrogen. We need to make sure, as more homes demand more power, as the economic development of this society goes up, that power is sustainable and renewable and so forth. Addressing the hard to abate sectors, cement, steel, etc., is really important as well. At AllianceBernstein, we have been a supporter of the Climate Bond Initiative since 2015. Around the time we invested in our first green bond, and we've been looking at this market for a very long time now. And we have frameworks for assessing all of these thematic bonds: green, social, sustainability, and sustainability-linked bond. Within the green bond market, it is a market that has grown and developed and matured to a point where we have taxonomies first initiated by the Climate Bonds Initiative. We have a European taxonomy that is very relevant for us as international bond investors, where all of our global investments come into scope, and making sure that green bonds issued out of various markets, including India, fit within those internationally accepted best-in-class standards is very important. And some of the issuance that we have seen from Renew, from Azure, from Adani Green fit those criteria, and that's something that we we want to be supportive of. On the hard-to-abate sectors, transition and accompanying that transition is very important. We are international bondholders and we look at things from an international perspective. So it's very important for the forward-looking plans of these groups and of these conglomerates that are very heavily involved in the industry, in the industrial space, to make sure that their forward-looking trajectory fits within a trajectory that is compatible with a 2-degree trajectory. So this is from you, and at the same time, within the industrial sector, we want to accompany transition, utilizing more scrap in metal manufacturing, usage of steel arc furnaces, and so forth. Obviously, the green hydrogen revolution is going to be crucial to achieving our climate goals. And so as Alliance Bernstein, we want to be able to accompany that transition. And with that, I'll open it up to questions.
Which sounds like you want more green bonds, Salima.
We do.
So Salima, I have
echo my peers from 91 and BlackRock. We want good green bonds where the frameworks are thoughtful and the forward-looking vision of the issuer is compatible with a low carbon world.
Yeah, so Salima, I have 2 questions for you. One is slightly controversial, so I'll save that for the last. But in terms of as an investor, we've seen that there was an entire phase of issuing social bonds because of the pandemic. Now that has come down, and green bonds are again in the forefront of issuance. On the balance, how important is transition finance when you need to evaluate something which is pure green by its very nature as an issuer? And somebody who wants to get there and is wanting to invest in the technology and the capex required to transition to a more green business. So, in terms of weightages, somebody who needs slightly more help in terms of probably a larger discount on pricing, and somebody who's pure green and is a regular issuer, how do you evaluate that? How do you keep those things in balance?
Yeah, so I'll address your question from green to social. So we have seen an increase in social issuance in the wake of COVID. If you look at the stats, social issuance has exploded. If you look at the underlying issuers, that social issuance has been driven by 3 major issuers only, which are government-owned entities in France. So actually, I think in terms of breadth of the market, the green bond market is still the biggest, the deepest, and the one where there is most evolution. And I think on the social front, it's a little bit hard for us to determine additionality, and a lot of the social bonds that we see are difficult to assess from that perspective. On the green front, it is very important for us in economies like India to think about this concept of just transition. These societies need, like the wealth of these societies and the wealth of the households is increasing. And with that, when we need to be able to accompany that, to ensure the populations have higher levels of welfare access to education, infrastructure, et cetera, et cetera. But we want to do it in a sustainable manner. And the only way to address it is by making sure that whatever infrastructure is built is resilient for the society itself and for the whole world. Because if we continue to do things the way things were done in the past 50, 100 years, we're going into a climate catastrophe that is going to be bad for all of our societies globally. So green is extremely important. A pure green renewable, granted that's assessing the green credentials of a pure renewable player is a bit more easier than assessing the green transition for a player in a hard-to-abate sector. However, we need to make sure there is willingness and conviction in the forward-looking trajectory, and that plans are drawn that are compelling from that perspective in order for us to be willing to invest in such structures. We think sustainability-linked bonds can be a good vehicle for these types of structures. But as I would echo some of the comments that were made by my peers in the recorded statements, some of the ratchets are not big enough, and then these GCP instruments are only relevant if over time the issuer only refinances in this format. So that's something that we want to balance our assessment to make sure that we end up with compelling SLBs. And at the moment, this market is just not mature enough.
Finally, one last question from my side before I hand it over to Sean to take a Q&A. Cost of complying with the various monitoring standards, reporting standards. For large issuers, is something which is something which administratively manageable. Do you think this will get simplified over a period of time? Because it just seems that there's more and more of that coming forward, and it may not be everybody's worthwhile to invest in that in order to issue, especially where the arbitrage between pricing between in the ESG format and a standard format may not be that evident in some markets. Salima?
So in terms of pricing, the greenium does exist, right? And it is very prevalent in some markets. And it is heartening to see, we have done some analysis at AllianceBernstein that the good structures tend to trade with a bigger greenium. And the market does distinguish between the good structures and the less well-structured green social sustainability linked bonds. And that's something that we really want to stress. These structures also have very interesting sustainability features. So if you think about Europe as the precursor to this market globally, this is where the market developed early on. Around March of 2020, at the height of the market volatility around COVID, we found that 10% of the bids in the market were for green bonds, whilst green bonds represented only low single digits of the universe. So there's a very compelling argument for investors to invest in good green bonds. Not only investors that have these sustainable funds, everyone should take a very close look at this market, especially when in Europe now it's 30% of the market. The next geography that is looking at this very seriously is actually Asia, if you look at the technicals in this market. And we are seeing various technical factors in the Indian space, particularly pertaining to renewables and something. And this is something that we watch very closely and that we want to be able to take advantage of as investors. In terms of pricing at issuance, those good green bonds are very resilient. And in Asia, we are starting to see signs of Asia converging to where the European market is at the moment, and differentiation between the good structures and the less good structures.
Thanks, Salima. Sean, over to you. I think we have about 7 minutes. So probably we'll have to keep it, make it quick, and then we can move on to the vote of thanks and closing comments.
Look, I think I've got an all-encompassing question for everyone, really, from Pawan to Robbie. What do you see as the things you need, if anything, to be honest, to be able to grow investor appetite in this area? Is hedging a facility? We've had one question, for example, for some of you. Is there a need to bring more to bear in that area? Is there clarity about investor demand? Of course, this whole webinar is about doing that. What do you see? That's one question. And also, what do you see as the forward pipeline? People are saying, are all your bonds going to be green? Obviously, for HDFC, it's going to be a while yet, but we can live in hope. But for Renew and Azure already there, Robbie's already said 96%, I think, of forward investment is going to be green, which is an extraordinary figure, I have to say, given the scale of investment required. I guess I'm also wondering about what you're seeing of your peers. Like, is this under appreciation you've got of the opportunity of raising capital and doing more work in this area being shared? Do we have a movement in India now, or is it still the beginning of a revolution?
I think, Sean, if I take briefly the part of your question and leave it to others to take other parts. See that we see two very distinct drivers of this. The first and the foremost is that we ultimately, if it is debt investors, we ultimately have to sell solid credit. there is not a single investor who without appropriate credit is going to give capital to green if it's a label. So the first and the foremost responsibility remains to build an economic story that is economically viable and it works from a sustainability principles. In that hedging, some space in creating non-hard currency issuance capability, all of this will help. Whether that is done by large funds like BlackRock or it done by, we have to initiate it from a corporate side to support the market, or banks like HDFC or SBI have to assist and support in terms of creating domestic market trading capability and building the bookmaking in the domestic market. How that develops is one point. And second aspect of this is that from India perspective, we are currently average income under $10 per person. That will rise to between $10 to $16. Now, when that happens, it explodes, because at that level, you have a step change in everything. So people go from saying, I need a light bulb and a push bike, to people saying, I can actually get other things, I can actually travel also. And that step change, we will become world's top 3 aviation market. We will become world's top 3 internal logistics market. We'll become world's top data consumer. We're already there. We are world's largest digital transactions market already. So you can imagine the scale of data centers that will be required. Now we have our own planning on data center. We have a joint venture with EdgeConneX in data centers, and we are rolling out data centers. So you have this a step change, and it goes to, I think Salima mentioned, it goes to the point at some stage, if we do what, say, Europe did, 5% of world's population, 23% of world's carbon budget. If we end up at that, well, India would be like 70% of world's population. If we travel the European path, we'll be 85% of the carbon budget. And all this 1.5, 2 degree thing will just be fiction. So what we have to do is to meet the aspiration of the people, which we cannot deny, but do that in the manner that the energy intensity of that remains within acceptable range, that India peaks somewhere around 14 to 16% of the carbon budget, well below its population threshold. And that would be the underlying success if we from a green perspective. But we have to make that economical. So that is why we, like, for example, we are obliged to take that step in relation to green hydrogen and commit to that investment. To say that we will land the green hydrogen at $1 per kg. Because if we don't do that, then naturally economically viable transition is not possible. And they would have to then get funded by non-sustainable, because we have to meet aspiration. If we don't meet aspiration, we have a much bigger problem at our hands in the short term. That's all. Thank you.
Robbie, what's your time frame for meeting those price points? What's your view? What's your current thinking?
In which
for hydrogen? For green hydrogen.
Green hydrogen, we are on the way. So the green generation, we have a 5 gigawatt site where the site geotech, all the studies are done. It's sort of plant erection is what's left. Electrolyzer manufacturing is on. Electrolyzer work is on. We expect somewhere in the 2024-2026 timeframe.
Wow, very exciting. Mr. Rao, we need to talk, clearly. But your thoughts on how much of a revolution amongst your peers in industry is this? Are you as energetic and optimistic as Robbie is on this question? Or are you a bit more sanguine, a bit more cautious?
No, I think I am very, very optimistic as far as India as a country, the transition is concerned to hydrogen economy. Because one major significant advantage India has relative to others is the sunshine, which is available in India. So the transition to renewable energy, producing renewable energy at a competitive cost, is one of the greatest strengths of India. So once renewable energy becomes competitive, as I mentioned to you, once we create hydrogen manufacturing capability in India by way of PLI schemes and others, and also creating an ecosystem for transportation and storage. If these things are addressed where Government of India is very much committed to do that, I think we can transition much earlier than what everybody is talking about. So I'm very, very optimistic on that. The point here is how do we give comfort to the investors that this is the country which can transition quickly as a developing economy, decoupling with the carbon emissions. That means one side we are reducing carbon emission, at the same time as a country, as an economy, we are growing. And there are several companies who understood the importance of ESG adoption. So in that context, I think a very, very robust system of rating of companies, either you call green corporate rating or in terms of green energy risk rating. Thereby that rating should be standardized where corporates can get rated. That give comfort to the investors as regards to the adaptability to ESG and the risks involved in that for each company. So that can attract a lot of investments into India for this transition. But at the same time, as for the hedging question which you raised, is very, very important. Today, rupee bonds, there is a huge amount of interest from foreign investors. So their hedging is being done by the investors, but it is a shorter tenor. Whereas for this energy transition, the Indian corporates require longer term financing. So therefore, a rupee long-term bond will really help not only big corporates like us, but really SME sector to really transition very quickly. If the hedging is part of the overall pricing, rather than hedging being left to the issuer, I think that will greatly help. Today, rupee bonds are very popular for shorter tenors up to 3 years. If that is extended for green financing, I think it will be very, very helpful.
Fantastic. Would anyone else like to jump in? Oh, by the way, Mr. I need to say that the Climate Bonds Initiative will be later this year rolling out entity certification. In other words, not just the bond, but we'll look at the company where the trajectory of change is ambitious enough to meet our 1.5 degree targets. I mean, I'm going to say Azure and Renew, they qualify pretty straightforwardly. But for JSW, it'll be an interesting conversation to have to be able to then say to the market, in fact, we are very ambitious and there may be implications for listings as well. So I'd love to come and talk to you about that when we have that program in place. Anyone else like to chime in on this question of issues that need to be addressed and the extent to which you think we have a revolution here?
So may I come in? So just wanted to say, because you wanted to know whether in India there is it really a very serious subject or whether it is just a passing subject and things like that. I must say that based on my limited interaction with various stakeholders, whether it is the regulators on the capital market side or whether it is regulators on the financial regulation side or on the Government of India, I think the whole, there is a certainly a desire to move this forward, and they are looking very positively in terms of various things which can be done immediately. Obviously, there are, if you have to do a fiscal sort of intervention and give some tax benefits and things like that, that takes a longer time because it gets into the fiscal side of the thing. But there are a lot of smaller things. For example, if Indian companies were to raise bonds within India, which are green and sustainable and all. So on the asset side, whether the regulators can qualify some of those assets which are eligible for PSL, priority sector lending, or, there is this affordable housing bonds, which can be issued by the banks. Now, if those bonds are actually issued for green and ESG sustainable programs, and on the other side, on the lending side, on the other side of the balance sheet, which is the asset side, they get benefit in terms of priority sector, in terms of CRR, SLRs, which are not applied on those bonds. So these are some of the small things which are already there in existence for normal issuances. So if they get extended to the green side of the program, I think it can immediately sort of trigger a local sort of a market for all this thing. And of course, as Mr. Rao said, on the hedging side, I think it's a very live issue. And this has also been highlighted to see whether there could be an agency or something which could actually provide hedging at an affordable sort of a cost, particularly if it is related to any of these directed ESG type of activities.
Thank you. I know we're out of time, Gaurav. We need to wrap up. Just a couple of questions I'll answer. What's next for certification, for green bonds, for the green bond market? Transition, steel, like JSW, chemicals, and so on. Climate bonds rolling out criteria later this year. We've already rolled out criteria for grids. We would like Indian grid companies. I won't mention any organizations here. There's one representative on the panel to bring together out green bonds for green investments. We're looking at blue bonds. We've already got criteria for coastal protection measures and resilience measures. That is, measures like water infrastructure that will ensure India can survive what are going to be the shocks of the 21st century from the impact of climate change. There's a lot happening. It's very exciting. We need to wrap up. Gaurav, over to you.
Rita, a quick vote of thanks from your side, and then I'll ask Shashank to give his comments before we end. Rita, over to you.
Thank you, Gaurav. I think it's been a fantastic discussion and really has brought together the issuers as well as the investors' perspective on this very important topic. And as FICCI, we are very delighted to be part of this dialogue and discussion in India. As Sean knows, and as you know, we started our sustainable finance journey with the UNEP on the design of a sustainable financial system in India. And then that led to our work on green bonds with climate bonds with HSBC. And thereafter, FICCI's steering of the India-UK Sustainable Finance Working Group, where we are really doing some deep work on taxonomy and the regulatory aspect related to sustainable finance. And also what could enable and unlock international and domestic finance flows. And what we are seeing is a tremendous response from the government, from the regulators, from the stakeholders in industry. And with the recent announcements at COP26 in Glasgow, it has given a huge boost to ESG, to an already growing momentum around ESG in the country. Also with the SEBI's BRSR mandate, which is going to kick in very soon for companies. I think the momentum in India around ESG and on green bonds is really going to grow at a tremendous pace. And what we're also seeing is, I heard some of the panelists talk about, the need to have a shelf of projects. And what we saw last year in a report that FICCI and EY did, where we identified shovel-ready projects, almost 600 projects, which are shovel-ready in the pipeline, that have the potential to generate 1.5 million jobs and 6 lakh crore worth of investments. So it's not that the projects are not there. What we are seeing is the need for hand-holding industry in helping them to develop the pathway to an ESG pathway for themselves, because we are seeing the momentum around net zero announcements by industry, the RE100 announcements, etc., which I think is going to create a really huge scope for investing in different areas. And we also heard, some of the panelists talk about the different kinds of initiatives and sectors that they are potentially looking at. And there, as FICCI, we see a very wide scope. And it's not just about energy. It's about all the hard-to-abate sectors. It's about transport. It's about water and waste management. And when we talk about these sectors, it's not about just the projects that are going to generate energy or the projects for water and wastewater. It is also about creating the infrastructure. So whether it's the infrastructure for waste management, for water recycling, for EV charging, even decarbonization of transport. There are so many things that that would lead to a decarbonization journey, including multimodal logistic parks, the modal shift. There are so many opportunities really to harness if we talk about the decarbonization journey, and therefore ESG linked projects and ESG-linked bonds, I think, is an immense scope. And we ran a survey, an industry survey last year in the run-up to COP26, where industry has clearly come out with the demand for the decarbonization journey to include new and emerging areas of technology. So it's not just about different kind of projects across this sector. It's also about investing in new and emerging technology areas like hydrogen, like long duration pump storage, battery storage. So many areas. So I think today's discussion has been really insightful in understanding what how the investors and the issuers look at this. And of course, I think there's also been talk about how taxonomy is going to play an important role. And I must say that the government, the Ministry of Finance, has really started a great discussion and effort in this direction by constituting the Sustainable Finance Task Force, of which FICCI, CBI, all of us are members, which is looking at how India could look at the regulatory environment, taxonomy development to unlock some of this. So I think today's discussion has been great, and I want to thank, on behalf of FICCI and all the organizers here, the excellent discussion, and thank all the panelists who have joined us here today. Thank you so much.
Thank you so much, Rita. Shashank, your take on this before we wind up?
Sure, I'll just quickly. So thank you, Gaurav. We at MUFG are delighted that we could partner Climate Bonds Initiative and FICCI again to organize another stimulating webinar on this very pertinent topic. All the speakers and panelists have given us a very good insight about how the respective organizations are embracing ESG. MUFG has been a global leader in green and sustainable financing and will continue to support our clients in their respective ESG journey. In addition, in India, MUFG is proud to have partnered 15 large ESG financing transactions recently, and we were the ESG advisors in half of them. We are committed to use our deep knowledge and experience as ESG advisors on many deals across industries to support our clients. Similar to the previous webinar, this year's panel has been gold standard. In addition, we did get an opportunity to hear from marquee investors as to how they look at ESG investing. It has been our privilege to partner with this set of socially responsible issuer and investor group and contribute our bit to promote ESG financing in the region. Thank you, everyone.
Thank you. With that, we bring the webinar to a close. Thank you all. Goodbye.
Thank you.
Thank you, everyone. Fantastic.
Thank you.
Thank you.
Thank you. Thank you.